All right. This is great. Um, one of the reasons that we started this event 10 years ago was the conversation was, a CPA and attorney in our bar. And it sounds like a joke, but when you're meeting with your CPA and you're trying to do some estate planning, and there's nothing worse than having a CPA say, that's not a question for me, that's a question for an attorney. What if we could get them all in a room? And that's what we've done today. So it's why we've structured it the way that we have. It's a 20-minute introduction of updates and some mistakes that we see investors making. And then the second half of the entire day is beating up questions that you all have and that we end up having. All these panelists are experts. They belong to organizations that are lobbying on behalf of our industry, and it's specifically their specialty. And it's just really cool to have them here. So if you use the Q&A box for me, Joey is helping me. I have the questions in front of my screen. I know Dad has questions. I've got some questions. So Dad, how about you start, and we'll go from there.
I would love to ask this question because I didn't know the rule had changed. So how was the homestead exemption changed? What was the process? I don't recall voting on it. And I just,
No, Bruce. The answer, it was not a vote. It was not a proposition. It was I forgot the name of it. It was Senate Bill blank blank blank, Assembly Bill blank blank blank. It's a bill that emerged from the Assembly, was passed by the Senate, and went to Gavin Newsom's desk probably 3 weeks ago, 4 weeks ago. Signed it on a Friday night and goes to effect January 1st. It's an excellent piece of, hard to believe, an excellent piece of asset protection, creditor protection in California.
yeah, kind of unexpected. And I guess I was trying,
Absolutely unexpected.
I'm always trying to figure out the process of how laws get passed, like rent control, because we voted against rent control and yet we have it. So I always want to know, okay, is that a process that we get to participate in, or, in this case, it turned out to be positive. Next year they could say, well, we're taking that away and making it zero. So I just wanted to understand the process.
Yeah, the one of the things to most of the court cases that when we have a proposition that has happened in California, the courts do not have constitutionally the ability to overturn a proposition which has directly been passed by the people. So in California, legislation rules emerge from the Assembly, they emerge from the Senate. They can emerge from the governor's office to the Assembly and the Senate. And if they can't seem to do it there's a groundswell movement in California, which is a proposition, meaning this did not come out of the Assembly, this did not come out of the Senate, this came up from the people, and we put it to a vote to the people. And so you have those two different methods of bringing legislation through in California, some of which have been good, and some of them, like the private attorney general status, PAGA, just been horrible. But they've been put through by proposition rather than by legislation.
Okay, thank you.
I'd like to point out that the people haven't always been the losers, or investors, I should say. It's been really interesting to watch accessory dwelling units and some of the latest bills that was passed and Gavin Newsom signed in September. Basically doesn't allow HOAs to include ADUs as part of the calculation in the percentage of rentals inside the HOA. So one of the tricks that HOAs were doing to stop JADUs and accessory dwelling units from being built was saying, hey, there's a cap limit of 25% rentals in this neighborhood. And it was reasonable because some lenders look at a threshold of rentals in the area and they won't do any more owner-occupant loans. But consistently, the state has come out and squashed everything that's been coming out because we have such a lack of affordable housing. So that was a really interesting one to watch. Matt and Amanda, really quick. Dad, if you and I can go back and forth, this will be fun because I've got screens and I've got questions. Donations. Are donations this year 100% tax deductible as part of the CARES Act?
Yeah, so one of the changes of the CARES Act is that you can donate up to 100% of your AGI this year. So before it was, in the past it was actually 50%. Recently it was up to 60%, but now for 2020 it's up to 100% of your AGI.
I just want to point out, can you mention really quick, it happens to be your birthday today, happy birthday.
Thank
You
you.
also have a cool nonprofit event that you do. If you could just share that real quick, if somebody happens to be looking for a place to make some donations by the end of this year.
Well, I appreciate that. Yeah, we founded an organization called the Animals for Armed Forces Foundation. It's a organization that sponsors and underwrites free pet adoptions for military families. We're 9 years now, 10 years, something like that. And we're running a promotion, a lot of shelters in Southern California through the end of November. So if you would like to donate to help us do that, you can go to animalsforarmedforces.org. So thank you.
Very cool. Pops, you got questions?
Oh, yes, I do. I get, Dino, this is probably for you and Harry. Let's say on an exchange, I'm going to do a 1031 to a new home that's being constructed, and it doesn't get done. Day 180, and I've got most of it done, but I don't have a final. I don't have a CO. How does that work?
Okay, well, from the exchange perspective, the key to the exchange to remember is that when you obtain the replacement property, it has to have the value there at the time. Having a certificate of occupancy is not a requirement for the exchange itself. So the question is, if the building is not 100% complete, are you acquiring what you actually identified, and is the actual value for the bricks and sticks there at the time you go on title to the property? What generally becomes a huge issue, and why they're most of the time not doable, is because the contractors, the developer has loans. And if there's loans associated with them constructing the building, the lender's probably not going to release the collateral until the certificate of occupancy is there. So,
Let's say it was a cash deal. I'm always asking things that I'm doing, so.
well, I mean, the answer is, did you acquire in real property what you identified at the time that you're now going to go on title to the property? It's like an improvement exchange. An improvement exchange, when we're on title to the property, the building doesn't have to be complete. You just have to have the money in the real property. So in other words, you can't give the money to Bob the builder.
Right. Okay,
it has to be in there. So the value has to be there at the time. So in the event that you ever get audited, you know, Amanda may have to come to your rescue and say, yeah, the building was there. How do you prove the value of the building in that situation? So.
Very good.
Okay, but a not completed building might be worth 90% of 100%.
Well, it depends on what your exchange value was. Did you spend all your money? Did you buy other property?
Right.
Okay.
Okay.
So it's going to get down to case by case. But just so people don't get the idea that you can run around and do this, it's very, very difficult, if not impossible, to accomplish.
Okay, Karen, I think we should cover this real fast, and then it's going to have a follow-up question. The penalty for doing investments in your IRA wrong, can they go backwards from the time I make the mistake, and what could that look like? And then let's talk about some updates with IRAs this year because of COVID.
Right. Well, if you commit a prohibited transaction within your IRA, there is a lot of times there's just no limit to how far they can go back. It goes back really to the date of the infraction, and you can pay back taxes and penalties and things like that. So prohibited transactions, the only way to stop that and set a clock is if there's some sort of tax return done, like a 990T or something like that in the account. Otherwise, you just have to be super careful not to commit a prohibited transaction.
And as far as COVID-related changes, what's been going on with the IRA world this last year?
Right, well, quite a bit, and Matt and Amanda really covered it quite well when they were speaking, but I think one of the biggest things is the CRD, the coronavirus-related distribution, where coronavirus is actually mentioned. And that says that you can take $100,000 as a loan from your 401k or $100,000 withdrawal from your IRA. If you take it from your 401k, you're paying it back. If you take it from your IRA, you have 3 tax years to pay back that withdrawal. So that's nice. So if you need the money, you can take it. Now, in order to have these benefits and be able to have access to that $100,000 as special CRD, you have to be able to prove that you were affected by coronavirus. And the IRS on their website has a list of conditions.
Yeah, I don't know whose situation this is, but let's say that you're 1031 exchange and you have your property in, no, let's call it a family living trust. Okay. So when you're doing the exchange, you're buying in your family living trust. And then I meet Harry and he scares me to death and says, you ought to put that in an LLC. Mm-hmm. If I transfer that, is that a taxable event, or how do I avoid a taxable event?
Well, I'm going to speak to the exchange side, but from the exchange perspective, the same taxpayer selling must be the same taxpayer purchasing. So did the taxpayer change in any way? So is that LLC disregarded to my family trust, which is disregarded, say, to me personally? So in that instance, nothing has changed from the 1031 side.
The 1031 is exchanging to exactly the same entity that held the relinquished property. I'm talking about a month after I do
Oh,
I do
yeah.
title planning and say, I'd like to transfer this to an LLC because Harry scared me.
Well, I'm out of the picture at that point,
Okay.
after the exchange, but I don't see how it is, but we'll let the,
Okay.
Picture. And for a couple years, Bruce, if we exchange it into an LLC that's a disregarded entity, it's a no factor.
Okay.
Okay, let's start getting to some questions. As you use the Q&A panel, I'll start asking question. Will depreciation losses as it relates to REPS status be changed under a Biden plan?
That's a good question. We haven't really seen anything specific. You know, anything is possible at this point, but no, there hasn't been any indication that there's going to be changes to real estate professional status or what the rules are at this time. But yeah, again, anything could still change.
Dad, you want me to just keep going through these?
Well, I'll do one right now because since we got on the subject, I'm really curious about what the process is to change tax law. So I know, let's say that you have one side want that to be law. What process does it go through? Does it have to go through the Senate and the House vote?
Yeah, let me go through that.
Okay.
The bill will usually, it's emanated in different ways. So the executive branch, called the White House, can make a suggestion or a proposed tax bill. I know this because I was working on a committee in 1987. I worked on a committee in Washington. So let me tell you how this works. So you have, when the president proposes tax change or tax legislation, it comes from the Department of the Treasury. And then you might have Treasury 1, and then Treasury 2, Treasury 3. Those go to Congress. Congress then looks at it. So the House will look at it and either disregard it, make modifications to it, or come up with their own bill with some guidance from the executive branch, or emanate a bill in the House themselves. And then they will vote on that. Should they vote on that and pass it, then that will then move to the Senate. The Senate will fully evaluate that, and they will either not take it up, they will reject it, or they will come up with their own version of that, which is usually somewhat similar or sometimes very different than what the House version looked like. Then the Senate people sets up a committee, and the House people set up a committee, and there is a joint committee of the two to look at the legislation. When the joint people, they agree that this is something that both can go back, it goes back to the House votes on it, it then goes back to the Senate votes on it, and then it goes to the President for the President's signature or veto.
Thank you.
Question about Iras. I just invested in an art hedge fund using my checkbook IRA. Is that not allowed?
Well, I think the hedge, what you've invested in isn't the art, it's the fund. And so that is allowed. You can invest in a debt or equity position in assets like funds. And so that's completely allowable. Yeah.
Interesting. Okay. I'll follow up with another one. We purchased a higher value property in 2020. Can we carry forward our old tax base?
was it a primary residence or an investment property?
I don't know.
Well, I think first off, Prop 19 is not in effect yet
Correct.
in that 2020. So
Got it.
it's just not in effect, so it's the old law.
Got it. Okay. I think we've answered the question, but I'll ask it one more time very specifically. Does a transfer of a property from a family trust to an LLC trigger a reassessment of property taxes if the LLC is a disregarded entity?
Let me answer that. And it's not just whether it's a disregarded entity or not. The appropriate and proper transfer of a property from a family trust, which does not exist for tax purposes, into an LLC, as long as the ownership before and after is the same, is not a taxable event, whether it's regarded and or disregarded.
You and I were talking about this before we started today. If the proposition goes through about the inherited properties, has there been any discussion about some entity plays? Can I slowly start gifting kids part of an entity or an LLC as part of the strategy? Joint tenancy, is there anything that we can do that trigger allow the kids to keep the basis?
Well, based upon the raw proposition, that is, there is no answer. It's just very simple as it stands right now. If you inherit, if the children inherit a house from the parents' primary residence, and it's not used as Amanda and Matt said, as a farm, or they're going to live in the house, and we can't define yet what living in the house quite means if there's numbers of children and how that works, then the property is going to be reappraised and the tax is going to get jacked. These are questions. There are a lot of questions. I was just talking to my son the other day, who's an attorney in my firm, and we were talking about various different iterations and questions similar to that are going to come up from the group today on what if I use a trust? What if I use an LLC? What if one kid occupies it? What if the other kids don't? What if the kids own it, but we rent it from the kids and we were the ones that transferred it? And it goes on and on and on by gift and or by inheritance. And really, at this moment, we don't know the answer. Some of it will probably have to be shaken out judicially over a period of time, and in challenges, we just don't know.
I'm going to throw you a new one. I bet you haven't heard yet, and this is maybe a Matt and Amanda question. So let's define a farm. So apparently in California, I can grow anything in the backyard. Is it a zoning thing? Does it have to be an ag zoning? I don't know. What institutes a farm?
I would think probably, I mean, for tax purposes, that it's reported on the return as a farm. I'm not familiar with the backyard planting, how that's all reported for tax purposes, unfortunately. But yeah, I think I agree with Harry too. Like, there's so much that's just not defined yet, which makes us all very uneasy as we come towards year end. So much unknown, in terms of from a planning perspective.
Yeah. Yeah, Amanda, I think that we're going to see this is completely bizarre, but California, sometimes our rules lead to bizarreness. Everybody in the backyard may turn around and make, like you say, Aaron, make a garden. We put a bunch of crops in the backyard. We sell those crops to the local co-op for pennies on a dollar.
Right.
Say we have a farm, and guess what? That long as we have that, even though we're renting out the farmhouse, all right, and although we don't live in the farmhouse, it's still a farm. Now we're going to argue over what's a farm under California's tax code, not federal tax code, I think. And we may find a way. That's a great idea. We may find a way around Prop 19. We'll all have little farms in our backyard.
There's several investors. I know Linska's on the line today, so she's a big fan of ADUs. So, I'm stacking opportunities here. So farming and accessory dwelling units, you're welcome. All right. Dad, this is a question for you. Can you describe what the quadrant system is and where you think we are right now in the quadrant system?
Okay, a quadrant system basically divides the real estate market into 4 pieces. And so quadrant 1 is after a boom, you have a lull, you're a flat period. Quadrant 2 is when you have a market dominated by REOs. And the reason the quadrant system was created is just my own business. I had to figure this out because when I woke up in the morning, I wanted to do the most effective thing as a real estate investor. So if all I knew how to do was survive during a boom time, I would have no idea how to find properties when quadrant 2 hit and they were all REOs. And the opposite is true. All you know how to do is find REOs. What would you have been doing the last 5 years? Nothing. And so the quadrant system basically says, you see this set of charts, the market's going to react in this set of ways, and when you wake up in the morning, do this activity, and it'll reward you. So where are we? Well, I thought we were at the end of quadrant 4, heading into quadrant 1, and then the coronavirus happened. We flew back into quadrant 4, and how it ends is a really good question, because was there room on the charts for it to occur? Yes. You had room for it to go up, and it wasn't with a great set of charts. And now you have a super motivated event that pushed everybody to make decisions to either stay or to buy. And that was unusual. And when you have 2 months of inventory and 4 months of demand, guess what? The market will go up.
I think there's a conception, because you've gone to Florida full time, that you're just giving up on California. We're still lending hard money in California. So yeah, you want to talk about that a little bit?
It was a personal decision. I do want to not pay California tax, so that's nice. So I have moved my residence there, I vote there. Actually, the rentals that I have are also either in escrow or up for sale. So by the end of the year, I hope everything will be in escrow and everything will be in Florida. That doesn't mean I think that California is doomed or something. I don't. I don't like the policies. I don't like when policies are created or rules are enacted that I didn't have a process. I didn't have a say in the process. That concerns me. It seemed like they were able to just make decisions and all of a sudden there you go. And it bothered me. So if I don't know the rules of engagement, I like to go where I think I do. That was the basis of the move.
Really good question about the first-time homebuyer tax credit of the 15K Biden is talking about. Is there any word on what that is? When you would qualify for it? So if a spouse has never purchased a home, would it qualify for the husband if the wife has bought one before? Is it a time period play? Anybody know?
I think it's all kind of unknown, unfortunately. It's, like the specific proposals and the rates, he talked about that, the real estate professional thing that Amanda mentioned. There was we were laughing about it yesterday. There's some ambiguous phrase they were using, and it was just, you read it and you're like, wow, that could encompass everything, So, but yeah, unfortunately, I don't know the specifics of how that breaks down. I don't know if you know anything more.
No, I mean, in the past, we've had first-time home buyers tax credit too. I think this is, maybe a high dollar amount or maybe slightly expanded version of it. But I also thought that was so interesting about potentially new credit for homeowners who rehab their homes in distressed areas, because that's not something that I've seen in the past. And, for all the people watching HGTV that are into rehabbing their homes, maybe that would be a good opportunity.
To get on the show.
I got a question. Who fronts the 15 grand?
Are you looking at me? Oh, I'm just writing checks everywhere. Taxpayers, I'm assuming.
Yeah.
It's a printing press.
I'm gonna say this one more time. I said it in front. What's wrong with a nothing down loan program where we qualify people like we do VA loans, which are very successful, but you don't have a down payment. It doesn't cost the United States 15 grand a pop. You have a 2.5% mortgage rate you can get, which is affordable housing. See, we are given affordable housing. We don't need to write a 15 grand check. You need to make one foreclosure law for all of this, just this type of loan, where if you don't make your payments in 6 months, it goes to sale. The opening bid is not having anything to do with the principal. The opening bid's the late payments. The late payment is going to be bought. A 2.5% loan is going to get bought by an investor, or give it first crack to the new occupant owner. That's great. You'll change the percentage of home ownership by an enormous amount. And it's real estate's way to reach across the aisle and say, we want you to share in the goodies. Because here's what happens when you get to own a home. You start building equity and you start paying down your debt and you feel like you're part of the deal. And eventually you get enough equity where you get a credit line, you start being entrepreneurial and you say, you know what, I can play these games on the side and I can buy a house and fix it up and all that. And pretty soon you pay your house off. I mean, I took that route. It took me 3 or 4 years to do that whole thing and own a house free and clear. By the time I was 28 years old, because I got to play. You know how I got the first house? I didn't have to qualify for it because back then they had something called a simple assumption. I wrote my name on a sheet of paper. I sent in $45. I said, that guy borrowed the money, but I'm taking over the loan. I didn't have to qualify. And I might not have been able to qualify. It was 21 grand, and I was probably not able to qualify, but I was able to make the payment. So that's what instead of giving out 15 grand of money that you don't have, why not take a chance that 95% are going to make the payment and change their lives forever? Because all of us that have rentals, how many of us will give a 30-year fixed rental rate? No way. But you get to borrow money at historically low rates right now, and it's fixed. Your payment doesn't go up, which means you have spendable money going forward as you increase your earnings. So this is a direct hit to the young people who can't own. You haven't had a chance to save money. Here's your shot. I think we should do it.
I had a really good conversation with an investor this week, actually, that watched the I Survive Real Estate series, and he wanted to get more plugged in, and we had a really good conversation of what that might look like. I think a lot of people feel like they can't participate in some way, shape, or form, and there's a few different routes that you could do. You could certainly try to get elected in local politics. It's not easy. You could serve on boards and commissions, sort of like the Planning Commission. I'll let you know now that's a lot of work. Or you could serve on nonprofit boards that specialize in housing. What I often see serving on boards is that there is a severe lack of real estate professional voices on these boards. Realtors show up a little bit more, but the real estate investor voice is typically not there for people to understand that we aren't sharks, the kind of work that we do. So I would just, if you ever have any questions or you need some ideas on how to serve, it's not just about giving money. It's time and talent is okay by me too, but showing up more often. And I serve on Riverside's housing commission, where we're looking at affordable housing, and I'm bringing up the ADU thing. I use Property Radar, and I show them how many properties are non-owner occupied over 10,000 square feet, and they could be talking to real estate investors that own this stuff, have experience being a landlord, have access to private money, who could get these done non-politically and completely off the radar. Nobody can stop them, and help us build 13,000. And they had never heard it before. They had never seen the data. So I would just hope to inspire you that just get involved, be a voice at the local level, because it does make a difference. This is coming up in more than one question, so I'm going to ask this, and then I'm going to ask the question that's on the screen. Karin, this is for you. Can I co-invest with my IRA? And the follow-up question was specifically, is there any way that I can do a deal with my IRA where I can profit?
Yeah, that's a big question. Okay, so can you co-invest with your IRA? I mean, it escapes me about 2000-10, IRC turned 2000-10, I think that's what it was. But that said that you could co-invest with your IRA, but they're under specific conditions. So basically what it meant is that you couldn't benefit, because you can't benefit from your IRA. So in order to co-invest, you'd have to be able to prove that you could have purchased the property 100% personally, or 100% with your IRA. You just chose to co-invest. But when it comes down to it, I mean, when push comes to shove, you have to be able to prove to the IRS that you did not have personal benefit from your IRA, because that's a prohibited transaction. So can you? I mean, if you want to hire a lawyer and argue it, that's one thing. I mean, if you get called on it, I would just steer clear of it. It's just such a gray area, even still, to co-invest, because you can't prove that you didn't receive personal benefit from your IRA if you do in fact co-invest.
Okay. Dino, I have clients that want to move some investment property but don't necessarily want to buy more property. What type of assets can they transfer into? Maybe more on the passive side, like a REIT, I think maybe the question?
Okay, so the answer to that is, when you're doing an exchange, you have to buy real property. Now, there is a DST out there that you can invest into it, and it's a Delaware Statutory Trust, if you're not familiar with the acronym. That is a product where there's a sponsor that goes out and they buy large pieces of property, say $20, $30 million, and then fractional ownership starts coming in, and it qualifies for the 1031. A REIT itself does not qualify for a 1031. But there are Delaware statutory trust products out there that start off as a Delaware statutory trust and then roll into a REIT. So in that scenario, you might be able to do the exchange and then ultimately end up into a REIT product. But you cannot exchange directly from real property into a REIT. That's prohibited, because when you're buying into a REIT, it's stock. It's not real property. So you might explore sponsors out there that sell the Delaware Statutory Trust that do this. I believe BlackRock is one. I think Exchange Right may be one. I don't sell the product, so you might want to do some homework to see what Delaware Statutory Trust sponsor starts off as a DST, which qualifies for a 1031, and then subsequently rolls into a REIT.
Can an investor? Oh, sure.
So I was just going to say, if looking at an alternative to 1031 exchange, a good number of our clients are looking at is opportunity zone investing. So with the 1031 exchange, you do need to, what you sell your property for, the purchase price of your replacement property has to be the same or more than the sales price of your relinquished property, right? But with an opportunity zone, you actually only have to reinvest the gain part. So, an example, you could sell a house for $500,000, but if your gain was only $100,000, your replacement property in the ozone, you only have to reinvest $100,000 right now. So, depending on the situation, obviously, that the person's asking about, if you're not looking to buy a property in our example that's $500,000 more, if you only want to invest $100,000, that might be something you could look at.
Yeah, and also maybe consider offset strategy. So meaning if I failed a 1031 exchange or I'm not doing a 1031 exchange, some of the offset strategies would be looking at what else do you own in terms of real estate? Do I have other rental properties that I can pull out more deductions from? Is it bonus depreciation? Is it cost segregation? Because these oftentimes can help alleviate or reduce the taxes from the capital gains event too.
Oh boy, you guys have opened up the ozone can of worms, and I think we have to spend some time on it. So let's do it. Let's do it now. I want to touch base with a little bit of each of you, if that's okay. So Matt and Amanda, from what you've seen, let's talk a little bit about the benefits because it's changed. So when ozones first started, there was a little bit of more of a tax benefit that there is currently, correct?
Correct.
Can you tell people what that is, just in case they're looking at old videos thinking that they're going to get the full 15% credit?
Yeah.
Yeah, so there's a couple. There was essentially 3 tax benefits that they were kind of throwing out there when the opportunity zone first came out, but right now they're down to 2. One of them is so basically it works like a 1031 in the sense that you're trying to defer paying taxes right now on your gains. So one of the benefits is they're giving you the deferral. So if you sell in 2020, you don't have to pay taxes until 2026. So that's obviously a nice benefit. A couple other ones is you get a basis reduction, you get a step up in basis, sorry. There was a 5-year window and a 7-year window before, but the 7-year window's gone away just because 2026 is under 7 years now. So there's a 5-year window for the basis step up. But the big carrot they're dangling is if you can hold the replacement opportunity zone asset for 10 years, the appreciation that happens in that asset can become totally tax-free. So that's the big carrot they're dangling, obviously, is that, now obviously in everyone's situation you've got to look at to see if, are you going to plan to hold an asset for 10 years first and foremost, and look at the numbers to see if it warrants, because sometimes we have clients looking at 1031 versus ozone. A lot of times the 1031 actually pans out much better from a numbers perspective, so.
Yeah, I think there's some unusual risks too with the 1031 exchanged, an opportunity zone. I see when Keystone CPA helped the Norris Group put together a 2-hour presentation on, if you're part of the portal, don't miss it. We need to probably update it this year, but I think there's a misconception that you can't do it yourself, and it's literally a 2-page form with the IRS. So you can open your own opportunity fund, or you can go down around and find an opportunity zone fund to invest in. And a lot of those funds that I've been seeing, they weren't investing in residential real estate, they were doing commercial. So I guess my follow-up question is, how have your clients fared that we're going into funds that we're investing in commercial? Because it's a long-term play. So are people stressed out? Are they crying when they call you?
You have one issue that also needs to be addressed that's very important, and that is when you invest in an opportunity zone, the tax that's paid now, like I think it's 6 years down the road in 2026, it's going to be under the capital gains tax or not that is in effect at that time. So if they do away with the capital gains tax, you're going to wind up paying potentially 39.6%. And we also have to understand another difference is that the 1031, I believe, Amanda and Matt, is recognized in both California and the feds, and the opportunity zone, to the best of my knowledge, is not recognized by California, so we will be paying 13% to California.
That's absolutely correct.
Yeah, I think to answer your question, Aaron, most of our clients who are in the ozone space are passive investors in ozone syndications in larger commercial deals. So yes, it's correct that any of us could put together an ozone fund, just with, all it requires is 2 people and a legal entity. Of course, all these other tax requirements. But majority of people still go through the fund just because unless they're, a full-time investor doing a lot of significant improvements themselves, most of the times they're not doing that. So no, haven't really heard any negative feedback per se, but I will say in terms of our clients, I would say that the majority of people who are selling real estate do prefer to use 1031 exchange over opportunity zones for all these issues that we're talking about. The O zones I generally see for our clients who are exiting stocks and moving that to real estate, because in that scenario, a 1031 exchange is not an option.
Yes, man, it's like you knew where I was going. So, I mean, that's one of the huge differences between a 1031 exchange. So, you know, we're building houses out in Florida, and we did have more than one investor that had stocks in technology companies that they bought early on. And I've even talked to Bitcoin investors that were looking to get out. And under a regular 1031 exchange rules, that is not like kind. So, opportunity zones do offer that, but it's a little bit more of a long-term play, so you really have to have a long time horizon. Dino, it's day 46 of a 1031 exchange that blew up in my face, so I can come to you and we can start over, right?
If it were my world, I feel your pain. The reality is no. After day 46, you're done. Now, when the qualified intermediary is able to release your funds, that's also going to come into play. And that comes very interesting times, especially this time of year. Because if you have identified properties and you're beyond now the 45th day, we cannot release the funds until the exchange is officially over. And so the exchange is officially over if at this period of time could be April 15th. But now you're filing your tax returns and the tax man cometh. At the most, we're going to be holding it to 180 days. So there's no do-overs at this time unless there's been some presidentially declared disaster and you qualify for it, like what happened with the Treasury, the IRS Notice 2020-23. There were folks that were getting beyond the 45th day. So if you closed on your sale, for example, on February 1st, you had all the way to July 15th to be able to identify. So those people in that window that, well, I think it was February 1st through May 31st, we had the benefit of that extension of all the way through July 15th. So regrettably, right now, there are no extensions that I'm aware of. So you're just going to pay the tax when the tax is due.
And bear with me, audience, I'm just going to get through all these opportunity zones through each perspective because I think it's important. Harry, O zones and inherited, how does it differ? If I own assets in an O zone and I pass away, what should my kids be expecting?
Well, to the best of my knowledge, that becomes a taxable event because we didn't make the 10 years. And so when it exchanges over, the tax is due.
Yep.
When it's inherited. I think Amanda and Matt, I think that's the rule.
Matt and Amanda, you have anything to add to that?
Yeah, I think our understanding too, it's there is no step-up basis like regular stocks. So let's say you passed away and whoever inherits it, they just get your carryover basis.
Okay, just making sure. Now, Karin, it doesn't seem like you and I should be having a conversation about opportunity zones, but let's go into 1031 exchanges and O zones. Now, when I take a leverage out in an IRA, I am taxed at a potentially high rate, at which point the only way to avoid that would be doing something like an O zone or a 1031 exchange, right?
No, I don't think they cross. I think that if you are taxed within an IRA, it doesn't cross over. Agreed. Yeah.
No, within. So I'm keeping the asset in, but I've created income due to the leverage. So
I see.
So I could deploy 1031 exchanges as a way to defer taxes on capital gains in the IRA.
If you can, I would discuss that with Matt and Amanda, since
Okay.
I mean, it's a tax question, and I haven't seen anyone do it.
Okay.
Yeah.
It's not eligible for an O zone because that's not capital gain.
Yeah. I think maybe if I rephrase your question, Aaron, is if I have a transaction inside my IRA that does have capital gains, can I defer that by doing a 1031 exchange in the IRA?
Yes.
If that's your question, then the answer is yes. So the IRA can do a 1031 exchange to defer taxes within the account. Just like if you have unrelated debt financing tax, we can take depreciation to offset or eliminate the tax.
If there was a capital gain scenario, could I elect to invest the gains into an opportunity zone fund and do the same thing?
Inside the IRA, I'm not sure.
Yeah.
I'm not sure about that one, actually. I haven't heard that one.
All right.
Because it wouldn't be it's not an ordinary distribution,
Got it. Okay.
but I don't know. Yeah.
All right, let's go back to the questions. Using self-directed IRA, how easy or difficult is it to use it for the down payment and to get a loan for the rest? Also, what is the process to make this happen, and what are the challenges?
Right. Well, as I was saying earlier, it's probably one of the most misunderstood areas of self-directing, and that is that people think their IRA is the down payment on a rental property, and it isn't unless you're getting a non-recourse loan. So if you're getting a loan from Bank of America or Wells Fargo and you want to use your IRA as a down payment, that won't work. The lending institution doesn't have any recourse against the IRA, so they won't make the loan. So what happens is then you've got your IRA, you've got the property, you can go to a non-recourse lender and then discuss this and talk about the scenario with them. Typically, they're going to want to see you have more skin in the game, or that your IRA does. But there are occasions where a non-recourse lender will make a 90% LTV loan to an IRA. But you just have to remember that the percentage of profit that your IRA earns due to leverage does have that UDFI tax attached to it, and that's quite high. It's not 100% of the rent, it's just the percentage that was earned due to leverage. And then you'll have Matt and Amanda, or your tax advisor, file a 990T and hopefully get some deductions. and then maybe you won't owe the entire tax, maybe you get a little break there, but that's how it would work. You contact a non-recourse lender and discuss the property, and then also they might want to see a rental agreement before they make that loan to you. They want to make sure that it's truly a rental property, that's truly the purpose, and to make sure it's going to cash flow before they'll take the risk.
I'll add a few.
Can I just-
Yeah, go ahead.
I was just going to ask a question. Let's say I hit a home run on Bitcoin in my IRA, and I don't even know if that's allowed. And I pay off that loan that I got and then sell the property a year after. Does that change the?
It does.
Okay.
It does. Yeah. So UDFI isn't due a year and a day after you pay it off, so that it goes away then.
Okay.
Yeah, a year and a day.
We've actually had people use that strategy where they've sold a property. They had two properties in their IRA. They sold one, collected cash, used that to pay off the other one over the next 12 months, and then sold the second one and didn't have any tax due on the second
Okay.
one.
Yeah.
I've got one other thing, because I know how investors think. So on a 1031 exchange, the property that I wanted to buy on day 45, it disappeared. And can I just backdate the agreement that I find a property 3 days later that I really want? Can I backdate it to day 44? Is there any problem with that?
It's called 3 hots and a cot. If you no, not with us. No, because what's interesting is in Matt, Matt and Amanda know when you've done a 1031, there's an 8824 form. So the 8824 form is basically going to state when did you acquire, when did you identify, when did you sell, all these dates there. Every audit letter that I've ever seen come through my desk because we'll get letters from clients that have been currently under audit, generally from the state of California. And so in every one that I've ever seen, it's 2 pages, and always ask, show proof of when you identified. And if you can't show proof that's substantiated, you've actually lied on your tax returns if you're trying to backdate something.
Is that a
So-
felony?
Yes. Yeah, there's
That's
a
what I
case,
wanted to-
there's a huge case on Dobridge versus a commissioner. which
He's
is going
asking
on.
for his friend.
That one I am.
Personally, I'd like to get rid of the 45 days. You have 180 days, just close the deal. You have to have an accommodator, but that's not going to happen.
It's funny you ask about that, though, because I had a situation come up recently. You mentioned the 45 days and the disaster areas and stuff. We had a client that had identified 3 properties, and the one they wanted to buy, the seller, which I think was a home builder of some kind, took it off the table because they got a better deal from somebody else. And this is like getting close to that 45-day window. Now, for them, she was fortunate enough to be able to extend it because they live in Northern California, and there was one of the brush fires fell in one of they were living in a disaster area, so they were able to luckily extend the deadline. But she was asking that question. I was like, I haven't heard of that where the builder / seller just takes it off the table because and now you're stuck.
Yeah.
Yeah, well, that's why you have to have backup properties.
Right.
You've got situations where even if you've identified, say, for example, 3 properties, you plan on purchasing 2, one you end up no problem with. The second one that you want to buy, you find out it doesn't appraise properly or whatever, not going to close. What's that third property? Is it still available?
Right.
So the rule is if we start a big enough fire, we can get an extension.
Only if the president says so.
Wow, apparently we're going to be doing some video editing now. Great. I did want to add a little bit of a layer to the IRA and the non-recourse loans for wills, because we do them. I say we do them, but it's very rare. The very first question I always ask, does the CPA know what you're doing?
Yeah. Right.
And typically they say no. They've gone to a seminar and been sold that this is a tax-free environment that they can do anything that they want. And typically they just don't understand the tax ramifications that are coming and how expensive it can get. And I always tell them to go back to their CPA. At the Norris Group, we qualify the IRA like it's its own entity. We don't really look through. We want to make sure that the investor is solid, but really you're trying to contain the entire investment inside the account so you don't run into any problems. So we're never going to do a loan where we're going to completely leave the account cash strapped to where no uh-oh moments could happen. So the LTVs are a little bit lower. It's just not as easy as people think. So I would just be really careful, make sure they run the numbers first. And it really depends on their timeline horizon. So a lot of investors want to hold really long-term stuff. And longest thing I've got in California is 3, and in Florida 5. It's just, it's just difficult. There are some lenders out there that will do longer at this point. Non-recourse has been around for a long time. It's just, with COVID, if they're still doing it, I don't know. Let's see. For Bruce, self-employed people received EIDL loans and are able to take out their IRA savings early without the penalty. I have heard many people using these for down payments. What happens when these funds dry up?
They do become. I'm trying to remember the actual term. It was.
It's years, right?
It's,
Two.
it's 6 months deferral and due in 30 years, and then it amortizes over 30 years.
Okay.
Okay.
Okay. I have an account that is inherited IRA from my mom's passing and has not transferred to me yet. The company holding the policy tells me that I can no longer transfer it tax-free as an inherited IRA after December 31st, 2020, the year after her death. Is that true?
It doesn't sound right to me at all. There have been some new rules about inherited IRAs, but you can, if you're the beneficiary of the IRA, then you're the beneficiary of the IRA, and you would acquire it as an inherited IRA, and it would be a tax-free transfer.
Yeah, I think what they're talking about there is that, yes, it's an inherited IRA, but the issue that comes to play is what's the tax treatment to Aaron on that? So where it used to be that they would be able to extend that over Aaron's lifetime, in a stretch IRA.
Right.
That has been changed, and I think that's brought down now that it has to
5
be
years.
within 5 years.
Yeah, 5
5
years.
or 10. Yeah.
Whoa.
It's limited.
My brother and I inherited my late mother's property in October 2019 and are using it as a rental. Will the Proposition 19 affect this property? Good question. And crickets.
I'm not aware it's retroactive.
When you inherited it in when?
October 2019.
Then no, it's not affected.
Linska asks, what is the contribution amount for Roth IRA in 2021? Any changes?
No, the traditional and Roth IRA contributions are the same. So it's $6,000 if you're under 50, $7,000 if you're 50 plus. It's the SEPs and the solo Ks that saw overall increases from 57,000 to 58,000. Everything else is pretty much the same as far as contribution limits go. The simple IRA is the same.
Okay. Here I'm going to go back to you. Is there any way that I can save on that $800 entity fee if I'm in California? Can I just open a DST anywhere? And how do they even know I have an entity I've created in Florida or Delaware or wherever?
Well, if you start by the simple rule is that you may have created an LLC, let's say in Florida or in Minnesota or in Texas, Wyoming, Nevada. And get even further that the property is located in Texas, Wyoming, or Florida, but you are located in California and you are the manager of that LLC. Even if you have a property manager, the question is can you hire and or fire the property manager. Under those circumstances, the FTB in California take a very draconian look, saying if it's being managed out of California, you're doing business in California, $800. On the other hand, if you are not the manager of that, but you have another manager who's not a California resident, then you don't have to pay the $800.
Wait,
If
hang
you
on.
do, and then, but now the second part of your question is, how does California know about it? Well, the simple act sometimes of opening a bank account. If it's not a disregarded entity, there's going to be a tax return that's filed with the feds, and then the feds share information with California. If it's a disregarded entity, it's not showing up on feds tax return and not showing up in California, then you just breaking the rules, which a lot of people do, by the way. However, if California somehow identifies that you're the manager and doing business in California, they'll ask you for a California return. And remember, it's not a question of the income is a portion. At that point, you're either going to fess up. And what a lot of people do, believe it or not, is at that point when California starts rooting around under those circumstances, they dissolve the LLC and then create a new one and start it all over again.
It seems like California is going to be looking for some money next year. So on top of federal and state changes, states and cities can't print money, the feds can. So I would be careful about trying to play some games. But are you saying that if I'm a California investor that hires a property manager to manage properties that reside in a Florida LLC, that I don't have to pay the $800?
No, you do. If you have the ability to hire and fire that property manager. If you're the manager of the LLC, you are doing business in California.
Got it.
That's the rule.
And the rules, I know it's a really popular, Las Vegas's economy is surprisingly, the market is doing well, even though their unemployment rate is crazy. People are moving there for the tax play. How confident, Matt and Amanda, Harry, do you feel that the IRS won't be doing a lot of audits, and what are they looking at when somebody's trying to claim residence in another state?
Yeah, let me deal with that one, because we do deal with residence audits. So it's not the IRS that's going to be looking. Number one, it's going to be the FTB. IRS doesn't care because Nevada, California, same country. But California is trying to determine whether or not you really a resident of Nevada. So if you're really a resident of Nevada, you live there, you vote there, your gyms are there, your doctors are there, people are there, you could be a resident within 1 day of going. It has nothing to do with the 183-day resolution. On the other hand, if one is trying to masquerade, in other words, saying, hey, I bought a condominium in Las Vegas, I'm telling them that I'm there, 183 days, but I'm really in California. They've gone so far as they've checked water bills, they've checked electric bills, they've checked on how many times. The way they got one of our clients is the number of times and the number of days that they went to the gym. They went to, got the gym records. So it's strictly two things. Mentally, am I really a resident of Nevada? That's number one. Do I want to be a resident of Nevada? And two, do the facts and circumstances bear that out? So it's not a black and white. Just the fact that it's 183 days living in another spot is not enough to do it. It's facts and circumstances.
I just wanted to add one of the key reasons to distinguish the state of residency is that if you are a California resident, then California taxes worldwide income. Versus if you're not a resident of California, you are still taxed on any California-sourced income. Mm-hmm. So keep that in mind. That's one of the main reasons people, a lot of people no longer want to be California residents. And then Matt and I, we get emails all the time from AICPA, CalCPA with planning classes on residency, because this is certainly a huge question on the minds of a lot of people, especially for a lot of people who are, now that we're all working remotely. A lot of people working in the tech industry have been notified by their employer they don't need to be at the office until the end of the year or sometime next year. So people are asking the question, like, can I move to Florida for a short period of time? So I think there's going to be a lot of planning and clarity from that type of, midterm arrangements.
If I live on a cruise ship in international waters, we laugh, but I'm looking at I worked on a cruise ship for 6 months, and I know that there are some people who spent months on there. And as an employee on the cruise ship, I did not pay any state taxes because I was in international waters. Do you see? We ran into an investor too that was taking a 6-month cruise. So, you see anybody doing any interesting things like that?
No, because there's this thing called COVID right now.
Nah. For now, we'll see. If parents use an LLC or S Corp on all investment properties, will the taxes get reassessed based on market value? All we do is change the ownership of the corporation, and the corporation continues to exist.
It sounds like the question is from a property tax perspective, but if you have an S Corp that's owned by parents and they change ownership of the S Corp, yeah, I mean, that can become an income tax issue as well, but.
It's a different owner.
The answer there is if they change more under the rules, if they change more than 50% of the ownership, there's a control factor, but let's just use 50%. So I own 100% of the LLC with my wife, and then we give 51% of that LLC that includes the property to my son. That'll be a reassessment. If I give him up to 50% under current rules, that will not be a reassessment. And they should never had any property in an S corporation. Not a good idea.
No.
Can I ask a question? Aaron?
Yeah,
Okay.
go for it.
If they change the limit from whatever it is as far as what you can gift when you pass, and we got, 45 days left in the year, what decisions can you make? How much can you, let's say, donate to a children's Ira trust by the end of the year to try to circumvent that, if that's the right word?
Well, an IRA trust just scares me. We'll go to Karen with that because I think that's going to be disqualified. That's lineal. But the question would be is can we turn around and give a primary residence to children this year? Sure. And there's an unlimited primary residence to child or even grandchild exemption on increases in property taxes. Next year, no.
Rosa has a good question. I'm going to sell a single-family rental, and it looks like there's going to be a break-even considering the selling expenses. Can I avoid a 1031 exchange if I expect a loss or a gain no higher than $3K? Would the slight cost of a 1031 exchange offset the small $3K gain?
It's a great question. I think that's one that is misunderstood. It's sometimes in the 1031 arena is that people think that they always have to do a 1031 exchange, and we just remind clients that first and foremost you should look at whether you need to do one, right? So to the question, looking at if you're going to have a loss on sale, then no, there's really, and you're thinking off the cuff, there wouldn't be really any reason to do a 1031 exchange. If you're going to have a small gain, same thing. It's like what is the tax that you're going to pay, and then so that's going to be if you do an exchange, that's the tax that you're deferring, right? But if the tax is on a $3,000 gain, your tax is $500. You might, the fees that you're going to pay CPA or intermediary, whoever, is going to probably exceed that anyway, right? So.
And I think, in fact, if you're expecting a loss, you probably want to avoid the 1031 exchange because then you have created a loss that you can use to offset taxes from your rental properties or your W-2 income. So, if you're expecting a loss, certainly, 1031 exchange usually doesn't make sense.
But if I can chime in for a second, and I totally agree with you, because there's many times where people, their taxes are going to be maybe $5,000 or $6,000.
Right.
Why go through the headache for any of that? However, make sure that when you're looking at the numbers, like in the question that was asked, if you did an exchange into that property, that may not be the results that you're thinking it is from what you
Absolutely.
purchased to what you're selling for. And that comes up quite often. I was talking to somebody the other day that bought a property for $690,000 back in the heyday, and it plummeted, and then now selling it for $595,000. But there were like 3 exchanges prior to that one. So don't just assume what you paid and what you're selling it for and do some fast math yourself at the kitchen table. Go back to your tax person to make sure that what you're talking about are real numbers, because that could be an awful surprise.
Great point.
Is there an easy way that you guys talk about 1031 exchanges? I've heard replace the debt, replace the equity. Maybe Matt and Amanda, how do you sit down with people and walk them through it where most people understand it?
I think the way kind of we look at it is, in our eyes, there's really two main monetary, we call them monetary targets. So one is the replacement property purchase price. So as I mentioned earlier, the purchase price of replacement property has to be equal to or greater than the sales price of your relinquished property or your old property. And then there's the monetary target with respect to the equity. So the net equity you have from the relinquished property has to be put in as your equity into at least that amount into your new property. So, obviously you can look at sales price minus your outstanding debt. That's one way to look at equity, and you can factor in your exchange expenses in there too. But that's a quick and dirty way to know if you're selling for $1 million and the mortgage is $700,000, you in essence have $300,000 of equity that you kind of need to put in as your equity in your new property.
Okay. How would you handle, because of COVID, there are some nonprofits, I'm on the board of 211 in Riverside County, and they have just received millions, over $30 million. A local landlord got over $500,000 worth of grants as a way to help tenants plug back payments and rent. And I hopefully real estate investors, I know a lot of us own in a lot of different counties, please plug into your local nonprofits. There may be money that you don't even know exists if your tenants are having a difficult time, and you may have to help them. But from a tax perspective, does that change the nature of the income at all? Is it a gift? Is it, it's a grant? So how would you, as a how would that work?
I think I'd want to look at the terms of the grant really. Obviously in your space, Aaron, you probably have a little more experience dealing with the actual in and outs and the daily interactions with that. But yeah, because I can't give it an all-encompassing answer, I don't think, unfortunately. I think I'd want to look at the terms of the grants and, obviously a grant sounds like it's a grant, you're not going to repay it, but, who knows?
Yeah, I don't know, I feel like if it's like a replacement of lost rental income or lost revenue for tax purposes, usually that's just treated like regular taxable income.
Are you working at all with landlords that are looking at, a loss because of lost rent? Is there anything creative you've seen people do to capture that loss, or, I don't know, anything unusual?
That is a common question we get, especially for this year with COVID. People are asking, hey, I didn't, I lost out on $20,000 of the rent. Do I get a write-off for it? Practically speaking, most of our clients who are landlords are cash basis taxpayers, which means that they don't pay the tax until they get the income. So the fact that they didn't get $20,000 worth of income just means that their normal income was down by $20,000. So there's not an additional deduction because we started out at zero anyways. Of course, when your properties are vacant or people aren't paying even, you're still writing off your mortgage and taxes and holding costs and all that to create the loss. But there's not, again, usually for cash basis taxpayers, there's not an additional deduction besides the fact that you just don't have that taxable income from the lost rent.
Rosa, the number that to call is 211, and you might have to go, it's at the county level and it's nationwide. So if you go and type in the county and then 211, 211 is a Health and Human Services hotline number. And what's really cool about it is that the goal is to get your tenants to call, and one call could literally hook them up with a ton of local nonprofit resources, government programs from across the board, food stamps, rental assistance, utility assistance. You really don't know until you call. So it's 211, or just go on the interwebs and type in 211 in the county that your rental is in, and check it out. The grants are constantly changing, and it's just something interesting to watch. All investment properties are owned in property-owning LLCs, and those are all rolled up into a Wyoming LLC, which is owned by our Revocable Family Trust. Oh, here we go. This is when we get rid of the coffee, and now we're getting into the alcohol. Our daughter is the trustee. On our desk is a transfer of the trust to our daughter, a taxable event. Thank you, John. Nice. So, Matt and Amanda, is that for you? So LLC's pointing to a Wyoming. Daughter is the manager. What do you think?
For income tax purposes, no. Currently, if the
Gift taxes, yes.
Yeah, for a gift tax, it's certainly going to be reportable. But currently, at least, there's still, step-up basis, though the daughter would theoretically inherit the basis at the fair market value upon their death. And then, if there's gain to be sold thereafter, then the daughter would pay the tax on
But if
that.
they give it to the daughter, then there will not be a step up in basis.
Right, right.
Yeah, if she inherits it, yeah. Gift it, no.
So is estate planning grandfathered into whatever our government creates, dreams up? So I've just spent $1 million on my estate plan, and 2021 rolls around, and I get to start over, or am I grandfathered in?
Well, that one I can deal with easily. So traditionally, whatever planning you've done under the law that was in existence at the time that you planned it should be honored by the government. And one of the reasons why so many people from all over the world came to the United States of America because of our stability of tax policy and uniformity. Well, that's all gone out the window somewhat. As we said earlier on when Amanda and Matt were talking, that could Congress turn around, make tax legislation retroactive to 2020? Matter of fact, if Congress decides tomorrow that there'll be, 20 states instead of the number of states that we have, they can change it. If they decide they want to make it retroactive to 2015 and the president signs, they can do it. They're the government. They do whatever they do. So I think that, common sense would say, well, whether or not it's constitutional. Sadly, the case was brought to the Supreme Court as to whether or not they can retroactively impose taxes. And after a long, convoluted legal answer, the answer is yes. Now, the other side of that is that estate planning, like any other form of planning, like tax planning, financial planning, it needs to be vibrant. In other words, Aaron, the estate planning that you did in 2018 should be looked at in 2019, 2020, 21. Doesn't have to be a full reform, but it should be looked at. After all, we're all still not operating on Windows 95. We're on a number of versions later, and we see that all the time. People come in, and their estate plans, they've turned yellow and they have that musty smell, and they have been looked at in 21 years. They say, well, nothing's really changed. No, like anything else, it should be looked at. So the answer is that traditionally, what you've done is grandfathered in with potentially some modifications by Congress and should be looked at on a consistent basis.
Matt and I did a certificate of planned giving at Cal State Long Beach, and we learned a lot about estate planning and the gifting aspect. So when you're talking about going from 11 million to 3.5, I mean that's a huge change. So
not only is it a huge change, let's just put it in dollars and cents. When you go 11, just take 11 to 3, so that's an $8 million reduction. And so that's $3.2 million of transfer taxes times 2. That's $6.4 million that's going to the United States Treasury before it goes to our family. Not only that, the rate is probably going to move, if it changes, from 40 to 45, but I believe it's going to start at 45 and escalate on up as high as 65%. So again, we're reaching the level of confiscation, which means people will cheat. But the answer to the question, yes, it's very, very significant.
So what are some of the strategies? So you've got these kids that know nothing about real estate, and you're an investor that has this huge commercial portfolio, and when you pass, this kid is going to go, what do you mean I have to pay taxes on all this stuff? Are there insurance strategies that we should be considering? Should I be hiring a fiduciary or an attorney to take over? What do you do?
Well, I could deal with that one just a little bit as well. So that is a typical estate planning consideration. So one of the considerations we have is not only the ability to, from a tax perspective, sometimes we let the tail wag the dog. We have the tax perspective of, how do we deal with the transition of those assets from one to the other? And of course, what you're bringing up, Aaron, very, very thoughtful question, is whether or not there is enough liquidity necessary in order to pay the taxes, which are due 9 months the day after death. And yes, there are insurance strategies. Yes, there are estate planning strategies to deal with that, but they need to be dealt with proactively in advance. And there are some IRS rules on paying the some of the estate taxes in installments. They're not very good, but we have that answer. But you brought up another one, which I think was even more critically important, and that is that the people, or the children, or the heirs that are inheriting may be a relatively complex for them portfolio. There's a different accounting issues. Now there are tax issues. There are LLC issues and the other issues, and the beneficiaries are not prepared. We've attended financial tactics brunches. We've all gone to school. We've turned around and did it, but the people that inherit did not. So the people receiving the football don't know how to run with it when they get it. And we've seen more losses as a result of that than almost anything else. So the planning really needs to be both quantitative, dealing with the tax, and qualitative, dealing with the people.
I would just like to also point out the opportunity. So knowing that some of these tax changes might come if you're watching the daily paper, and if you're that person that knows how to find people in probate or whatnot, it might get more complicated, and there might be some opportunities dealing with heirs that have no idea how to handle what they just got presented. So just some opportunity there. I'm going to keep answering questions, asking questions. Harry mentioned protecting a house with your IRA. Does he recommend an LLC for each property and hence the $800 LLC fee each year, or is there a better way?
Well, I don't think I ever said anything about protecting a house with an IRA. That's just non-related. So let's move that aside. And Aaron, what's the question again? That is a non-issue.
In a nutshell, people don't want to pay the $800 in entity fees for the state of California, and they reside here and are managing the decisions from the state of California.
Yeah. That's a simple answer. You know, it's if you're going to be in the business of rental real estate, and you're going to be in the rental real estate business, California, it's $800 after taxes. Amanda, Matt, maybe it's $400. I am sure that they can adjust the rental income $40 a month. They have themselves totally protected rather than break the law. That's just the law in California. If you're managing it here, you control it from here. You're doing business here. We owe them $800.
Was part of the question also, like, because we get this a lot too, but maybe Harry, how many properties, or is there a number where you recommend how many properties are held inside one single LLC?
Oh, sure. That's a really good question. We see it all the time as well, and the answer is relatively simplistic. So remember, I told you earlier there are two forms of liability: liability to the owner of the LLC, and liability rising up from the operations, the real estate operations. So when it comes to me, I'm driving the car, I crashed the car, I kill, God forbid, 3-4 people. I have $3 million of umbrella, and I have $10 million worth of liability. They're looking at me now for to collect another $7 million. They look down at my assets, so it's going from the outside in, an owner liability to the LLC. It doesn't matter, guys and girls, how many properties are inside that LLC. If I can't get in, I can't get in. All right, and if I had 20 different LLCs, they'd put a charging order. I can't get in, I can't get in. Where the big difference comes in is the internal liability. If I have properties A, B, C, and D, and A, B, C, and D each have $400,000 worth of equity, and if I have them in one LLC, that one LLC is the landlord that has $1.6 million worth of net worth. If I have a liability at apartment or property A, it's going to take down B, C, and D. So there's where you have to evaluate just how much risk you want to take within one box. So if I had 4 separate LLCs, I know $800 each in California, my maximum liability would be $400,000. So a liability at A won't take down B, C, and D. Now, we're not necessarily recommending that every single property be in a separate LLC. But if you have a property that's got $1 million, $1.5 million worth of equity, and I have another property that has $200,000 worth of equity, and that $200,000 property takes down the one that has $1,500,000, that's a big mistake. So it's a case-by-case decision. It's a business decision, and not necessarily a magic formula. How much risk in any one box?
Good answer. All right. Client built a new home using Proposition 60 here in California. Property tax bill will be assessed a home at current market value, not considering Prop 60 arrived. Do you have to pay the higher bill or just pay taxes according to your old tax base? Assessor's office said you need to pay a higher bill, and then they will issue a credit after the property has been approved under Prop 60. Wow. Let's talk about first what is Proposition 60 in the state of California? Amanda?
No, I'm drawing a blank.
It's the transfer of when, if you're 55 or over and you're moving from your primary residence to another primary residence within the same county, you take your property tax basis with you to that. Proposition 90 would be any reciprocating counties, say LA to Orange County or something like that. You take your property tax basis with you. And that's what it is. Beyond that?
Yeah, but that's all changed now with Prop 19.
Yeah.
Prop 19 allows you to take it anywhere in the state and to apportionately move it higher. So again, we have not fully evaluated all of the senior citizens moving to higher properties within different parts of the states, but pretty much it's completely changed.
Yeah, we don't know logistics of all the bills either, so not fun. Once I turn 59 and a half, can I withdraw from my SEP for personal use without any penalties?
Yes, you can. 59 and a half is kind of one of those magic ages where now all of a sudden your pre-tax IRA money, you can take it without penalty. Now you have to pay tax if it's a SEP. A Roth, as long as you've had that Roth for 5 years, you can take it tax-free. But the answer is yes. 59 and a half is one of the golden numbers. Another number that I think, since I've got a minute to talk about what happens when you turn a certain age, is RMDs. Recently in 2020, one of the changes that we've seen is we've seen the RMD age go from 70 and a half to 72 in a month or something like that. And now we're looking at a bill right now, or Washington is looking at a bill right now that actually has bipartisan support. They're calling it Secure Act 2.0, and that's talking about one of the provisions of this is moving that RMD age to 75. And that has a lot of great applications, especially if you don't need to take your RMD. In fact, in 2020, as Matt and Amanda discussed during their portion, in 2020, you don't have to take an RMD, which is great. If you don't need it, then you don't have to have that taxable event. Wonderful. If you do need it, you can take it, but you don't have to. So 70 and a half going to 72, looking to go to 75 for that RMD age.
Harry, this is probably another one for you, or Matt and Amanda. This will keep coming up, and I think we've already talked about the answer, but maybe we could talk about the process instead of how we'll probably figure this out. If a property is held in a trust and the trustor of the trust passes away and there is a successor trustee that continues running the property in the trust, is it likely the tax base will remain the same? And the same question goes for an LLC. Sort of the continuation, how does anybody know? What triggers the actual step up in basis, I guess? And if we don't know, what would be the process to where we'd find out?
Okay, well, couple things. So the LLC is owned by the trust, and that's not the triggering event. The trustor, the settlor of the trust, dies. Now we take a look at what the trust says. Now you say it continues to be held in trust, but it's now continued to be held in trust for the benefit of the beneficiaries. So although there is no immediate notification, there is a notification that is required to go to the assessor's office as a change of ownership as a result of the death of the grantor. The question of how anybody knows, we've bumped into situations look like this. So sometimes people don't know. Sometimes the assessor's office is not informed. And then 15 years later, there is a property transaction on that property. And when you go back and file a preliminary change of ownership form 15 years, the assessor's office will actually go back for that 15 years and say that should have been reassessed 15 years ago. You were supposed to report to us and you did not, and they'll reassess all the back taxes. So eventually, you got to follow the rules. That is a change of ownership. There are the exemptions, but it's like anything else. Catch me if you can. If you play catch me if you can, you'll eventually get caught.
I just like this idea of just writing in the terms of the trust, like government should not tax me no matter what. Just write it in the trust. Can I invest self-directed IRA funds in an entity where I own 80 to 90% of that entity, and the entity purchases equipment to lease to third-party companies at fair market value rates?
Well, the answer to that is no. Okay, next. I mean, you can't. And the reason that you can't is because you're disallowed to your IRA is one of the reasons. So you're not going to invest in an asset that you own. Also, it's also a prohibited transaction to have personal benefit from an IRA investment. So if your IRA invests in a business you own 80%, you're going to get some personal benefit. So it's just prohibited. Don't do that.
Is it legal to pay prospective seller an option fee to keep property available in an IRA?
If it's, wow, I mean, first off, an IRA can disperse money if the IRA already owns the asset. Then the other reason we disperse money is to acquire an asset. So that's kind of like chicken and the egg. So if you don't own the asset yet and you just want to keep it available, is that actually acquiring an asset? I mean, there's some value there, so we would take a look at it.
But option contracts are something that you can hold. So
Yeah, so I see what you're saying. Okay, so yes, then yeah, your IRA can invest in an option contract.
Can I ask a quick question?
Sure.
I'm not sure who would have this situation, but what if you had an IRA and you said, you know what, I think I'll make a transition of all the funds to a Roth?
Yes.
What does that taxable event look like right now, and how different would it be January 2nd?
Well, I mean, I think it's going to be the same thing. If you want to take all the money in a pre-tax account and move it over to Roth, it's a conversion. And then that conversion is taxable to you, as Matt and Amanda can attest. It's taxable to you at your regular tax rate. So it just depends on how tax rates change January 1. And I don't think that we're looking at a tax change January 1, maybe in a little bit, but.
So that was one of the things we talked about in terms of year-end planning this year. So if you expect your tax rate to go up next year, might make sense to convert some or all of your IRA money into the Roth. So you're paying taxes at today's lower rate rather than future tax rate. Although it is a hard pill to swallow, right? Depending on how large your IRA is right now, maybe you convert part of it and not all of it.
Convert enough to stay in your current bracket. But you have to run the numbers for sure.
Yeah, if we knew for sure taxes are going up January 1st, I think more people will jump on that strategy. But because it's unknown whether that will happen, like I said, it's a hard pill to swallow for I think most people, especially with larger potential conversions, to convert a whole lot of money. But I think the mechanics of when you convert is when you pay the tax. That's not changing from year to year.
There's a second part to that. So you're a Californian that's moved to Florida.
For example.
Yeah. So is that event a taxable event in California?
Well, I would ask Matt and Amanda, are they going to tax you? Because
so currently, no. I mean, currently, so if you are currently a Florida resident, then your Roth conversion is not California income. And we have clients that are doing this type of planning a couple years down the road, people who are still working, that are already thinking about, okay, eventually when I'm not working full time, I'm claiming real estate professional, that's when I'll start to convert to
I'm
Roth.
actually surprised at that answer. Because during the years that I worked in California, let's say it was saved. It's sort of like having a rental. You sell on a 1031 exchange. California chases that, right?
Well, don't give them any ideas.
I'm not going to give them Okay, strike that.
Hold on. There was a court case on that, Bruce, and it started with the fact that people in California had set aside significant amount of pensions and deducted from their California tax return all the money they put into a pension, and then they moved to Texas and started receiving their pension. California sued to get all of that pension money taxed in California, and the Supreme Court said, no, violates the Commerce Clause and the Due Process Clause of the United States Constitution, and ever since then that hasn't happened. So it would be kind of a similar scenario. We kind of use that sometimes when we do Nevada incomplete non-grantor trusts to also help eliminate California taxation when possible. So the answer is when you leave California and move to Florida, that is not a taxable event, not under current law.
Thank you.
Is there a max gift we can give to children without paying taxes to avoid the Prop 19 ramifications?
Well, let me try to tackle that one. So the Prop 19 deals with inherited property. So an inherit primary residence, for example, primary residence going to children, which before was not subject to reassessment, that now will be subject to reassessment unless it's a farm or they live there, and we don't know how to define that. So now you have a scenario that during lifetime, if we make the gift this year to them in 2020, Prop 19 is not in place, so we can avoid that. And I'm not talking about the intersection on the gift tax, so as long as it's below the gift tax exemptions. Now, when you start making gifts prior in years following when Prop 19 is in effect, I would imagine it'll follow the similar structure that up to, this is a guess, that up to 50% of the gift will still not be subject to a reassessment, but the moment that we have gifted at least 51% of the entity or the property, then it will be subject to reassessment at that time. And if you didn't do it at that time, it'll be reassessed when you die anyway.
Oh, all these juicy questions. All right. When a property has a loan on it, how do you put it in an LLC? Because the LLC, the bank wants you on the loan and not an LLC.
I'll do that one too. I don't mean to hog the floor, but I just deal with these every single day of the week. So first of all, when the property is, the loan on the property is in your name. And I think, Amanda, Matt, it's section 754 or something like that. If you can't get off the loan does not become the responsibility of the LLC. You are still responsible for the loan. So that argument by banks is really not a good one. So, and not only that, it protects the equity of the property, which makes the bank's position stronger in their security than not. What you really get into is when banks make loans to property, and many times, we'll talk about house or other properties, they immediately want to sell it off to Fannie Mae, Freddie Mac, or FHA, so they get the money back and then they can make more fees when they do it. Fannie Mae, Freddie have characteristics of how they want that property to go. And one of the Fannie Freddie is that if it's in an LLC, they won't necessarily take it into their portfolio. It's kind of nonsense reason, but it is what it is. If the property is being held in the lender's own portfolio, or if the property has already been sold off or transferred off, as long as you make your payments, it's usually fine. We've probably done 3,000 to 4,000 of those types of transfers, and only really maybe 4 or 5 times if we've had real trouble with the bank at the end of the day. And then if there are some other ways to protect the property other than the transfer through the use of a land trust or a title holding trust and the assignment of the rights to an LLC rather than legal title, then the bank has no problem, because then the property actually remains in a living revocable trust, which meets all the requirements of Freddie and the FHA. Long, complicated answer, but at the end of the day, it can be done.
Okay. I am running out of questions, which is good. It's about the noon mark, and everybody's probably getting ready for a drink. This does get a little technical. Let's go one by one and talk about maybe some opportunities you see uniquely headed into 2021. Karin, let's start with you.
Yeah, I touched on a few of the opportunities, talking about like RMD ages going up, some of the things that we've seen, like we saw accredited investor status get loosened up and more people can be sophisticated investors. And I think that's looking to be expanded in the future. So that can be great for investors as long as you do your due diligence. Some of the other things too for 20 that started in 2020 and will continue is solo K formations. Usually this time of the year in mid-November, we're getting just slammed with solo K applications because you've always had to have that solo K opened by year end in order to take a prior year contribution next year. So if you wanted to take a 2020 deduction in 2021, you had to have that account opened by December 31st. Now that's off. So now you can, it's up to your tax filing deadline plus extensions that you can open a solo K and still contribute to it for a prior year. So yay, big change in solo Ks for those of you that are interested in them. We talked about the Secure Act and also about solo Rmds and that sort of thing. The CARES Act, we discussed that, and I think that, so that's another one. I think one of the things we could be looking at in the future, especially under a Democratic, presidential regime or whatever you want to call it, is more automatic retirement savings. So back when Obama was president, we had something called, instead of the IRA, the MyRA. And so people started doing this. It was for small businesses. There were automatic IRAs where small businesses would put small amounts in. They were ultimately invested in bonds, I believe. And then when Trump became president, that went away. So now they're talking about, the Democrats come back, let's have more automatic savings so that people can save for retirement. And so they're talking about automatic 401ks where perhaps even part-time employees would be automatically eligible to participate in a 401k plan so they could save. Other things we could be looking for in a new administration would be for caregivers, allowing them catch-up contributions. So if people are caregivers and they're not working, instead they're taking care of an elderly person, because of course we're in a silver tsunami, right? The most people changing, becoming 65, like 10,000 people turning 65 every day. So if you're a caregiver and you don't have the opportunity to earn a lot of money, you can have a catch-up contribution. That's one of the things on the table. And I think probably the one that is just irksome to me, but that's my opinion, is a possible repeal of a tax deferral for making IRA contributions and instead changing that from a tax deferral into a tax credit. And what that's going to look like exactly, I don't know. But instead of making it tax deferred, you would make it, get taxed on it, and then receive a tax credit. That is what's being discussed presently. So that's what I see. And we haven't had anything new in the IRA 401k world since probably TIPRA. I remember that, and that was back in 2010. So it's been a long time since we've had any real substantial changes. And now it's just, quite a few of them. So that's what I'm looking at here in the future.
We've got one question that just came in for you, so might as well ask it now. If I filed tax return married separately in 2018, in 2019 my spouse got unemployed, he could pull the money out of his IRA. Can I also pull money out of my IRA tax-free for 3 years?
I kind of want to look at that. But so if you can pull the money out of your own IRA because they are IRAs and not joint IRAs. They're individuals. So I would say no. What do you say, Matt and Amanda?
Well, the way I'm hearing it, but it may not be written that way, is if this happened in 2020 and, spouse is now unemployed, then I think you can qualify under the coronavirus-related distribution rules that you've suffered a adverse financial hardship because, you lost your job, under COVID circumstances. Then I think that would be a situation where that they could get the money out penalty-free.
But 2019, there's no look-back period. There's no coronavirus look-back.
No, that all kind of just started, basically whenever they passed the CARES Act back in February, March, whatever that was.
Okay. Dino, some of the things you're excited about in 2021.
What am I excited about in 2021? To be out of 2020? In the 1031 space, I'm not going to have as much to say as Karen did for sure. I think what we just need to see is what's going to happen with the election. Who's going to end up, what administration are we be dealing with, what it's going to look like in the Senate to see what kind of mix we have. Agree totally with what Amanda and Matt said earlier in reference to if there is going to be a one-party rule and there's going to be any major tax changes, it usually happens in the first year. So the anticipation would be if it's going to happen, it'll probably be the tail end of 2021. We're the 1031 space, so hopefully we're not put in that Jenga puzzle, if you will, of tax reform. So what's important for us to say is if we can stay out of what they may end up doing, if you have a one-party rule, that will save us. But if we're already there, baked in the cake, we're going to be eliminated. So I would say going, or reduced if anything. Going forward, just keep doing your transactions as you would. Keep going, and hopefully 1031s will still be around. So I'm hoping that nothing will happen, so that 1031s will be left alone, because they really are good for the economy. They're good for investors, and they're good for estate planning as well. So keep your eye on the pulse of the political landscape, and make moves as you start seeing things happen. And always, always, always keep in touch with your tax advisor and consult them.
Matt and Amanda, you're next. I'd also like some insights on what you see people sort of doing, some interesting things that have been profitable and safe.
Oh my gosh. Well, Bruce and I were talking earlier today about how, just the whole concept of like, in 2020, it's, prices have gone up. It's been a seller's market, and there's this, urgency of investors looking for properties, which is, somewhat kind of confusing comparing that against the data. So what do I look excited about for 2021? I mean, not much to be excited about on the tax side. As you saw in our presentation, it's mostly proposals of tax increases. But, like we said, unless there is the same controlling party for Congress and the White House, it's going to be, we're not likely to see a huge rollback of the Tax Cuts and Jobs Act. So bonus depreciation, those things currently are still going to be in effect in 2021. So, I think similar to Dino, we hope those stay there. But some potential good things. I think we can potentially expect more credits in solar, renewable energy, that type of space. How that impacts real estate investors, kind of yet to be seen at this point.
Yeah, I mean, I think one thing that I feel like is probably more likely to happen than some of those other tax changes we talked about, maybe that the state and local and property tax deduction, the cap at 10 grand may be going away. That would be good news, obviously. But in terms, I think it's, as Dino mentioned, it's kind of like maybe even more important than ever is to stay in touch with your team of advisors, not just your tax advisor, but just your whole team of advisors, at year end. And, we don't have all the answers right now, obviously. We don't know what's going to happen, but definitely don't wait till April 15th, obviously, right? Like, so I don't know. There's a lot of moving pieces, obviously. It's a matter of taking action. I wouldn't sit back and necessarily wait until you have all the answers. Make wise moves and make educated moves. But yeah, again, stay in touch with your advisors, and hopefully things move in the right direction.
All right, Harry, you're up next.
Simple. Well, you stay in touch with your advisors. So remember, like I said, Tara, help me. 47, 47, 47, we will help you. So please remember that. That's one way to stay in touch with your advisor or your potential advisor. I don't see much brightness, like I said, other than, as Dino said, the end of 2020, hopefully the end of the pandemic. But the net result of the election and the proposals that are made, I've never seen anyone be elected on raising taxes. It's just a very, very odd time. They do not have a strong mandate. The other party has 72 million votes. To me, all attention is really going to fall into the Georgia Senate races, which will control the Senate. And to me, split government is good government, because when they can't do anything, in so many ways, that's better for all of us to keep them out of our bonnet as we try to move forward and plan. So, that's basically, I'm saying the same thing as everybody else. It's time to sit down, talk to your tax advisors, work with your estate planning and asset protection attorney, get some good questions answered, and I think we'll make the best of it. And remember, it only lasts 4 years.
Perfect. I'm gonna add in, I would still pay close attention to accessory dwelling units here in California. You've got a lot of iBuyers that are going to come out of the woodwork this year as they pick up steam. Open Door goes IPO. Expect your advertising costs to increase if you're doing digital ads. When the pandemic first hit, we had an investor up in Northern California tell me that her ads went down, and as soon as they came back, the prices doubled. But even worse, her brand names, because she was big in the Sacramento market, tripled. So they advertise up against you. It's no fun. So obviously, I work with Property Radar. I think off-market deals are going to continue to shine, but those value-add opportunities with things like upzoning combined with accessory dwelling unit and apparently farming may come in handy in 2021. So pay attention. I don't have any other questions. So, Dad, let's close it out.
All right. I want to thank everybody on the panel. It's just an awesome event. You guys provide so much of your experience into these events, and it benefits everybody, including me. So I'm excited about that. Looking forward to 2021. I'm happy that we're in Florida doing the builds. I have a builder out there that I brought from California, so we're going to do 3 dozen or so build and flips. And I'm excited about the business model that we have, because one of the things that, again, I pay attention to charts, and I read studies that would bore most people, and I get a kick out of it with a yellow marker. But why I'm in Florida, too, is a business model that says that a great many seniors not only live there, will be migrating there. Florida is the recipient state of the most money by far than any other state. Number 1 is more than number 2, 3, 4, and 5 combined. So seniors with money go there, but there's a chain reaction to that. Seniors 65 have 2 caretakers in their life, or health professionals. By the time you get to 85, which a lot of us are going to, you have 7. So what that says is you're going to force migration of 350% of people going there. That's an astonishing thing. And when you own real estate and you have migration of people, I didn't know this was going to happen, but my rentals are occupied by nurses. That's typically what happens, because they're landing there because they're needed. So I'm excited about our business model, and I'm glad our clients are going to have a great builder to build some rental for them.
Okay, with that, thank you so much, and we'll see you next time.